Hello everyone, this will be our video lecture for class 12 where we will be going over limited liability companies and corporations. So we'll look into what limited liability companies are generally. We'll look at how it's formed. We'll look at the profits, losses, and distributions that are characteristics of limited liability companies. Then we'll look at a little bit about the management of a limited liability company, as well as liabilities and how a limited liability company is terminated. So following that, we will then look at corporations, what they are generally, how they're formed, the difference between directors and officers. We'll look at shareholders' rights, and then we'll dive into a concept that's unique to corporate law, which is piercing the corporate veil. So, what is a limited liability company? Well, a limited liability company, or an LLC, is different from a limited partnership or a limited liability partnership. They're called a limited liability company. And they are essentially a hybrid business structure that combines the limited liability inherent in a corporation and limited partnership with the tax advantages of the general partnership and the limited partnership. An LLC is a separate legal entity legally from its owners and investors called the members. Instead, they are essentially a pass-through entity, and these can essentially be the individuals, and corporate and non-corporate business entities may also be members. So you recall from the partnership formation, which require two human beings or more to form one. This one does not require human beings. It can be actually between individuals and a business, or simply two business together forming an LLC. So how is an LLC formed? Well, an LLC may be formed for any lawful purpose under a state statute. This could be selling flowers, creating essentially a new service, starting a new YouTube channel, or simply in order to maintain the estate of your family, let's say. So an LLC is formed by one or more persons when articles of organization are filed with the appropriate Secretary of State. So in most states, there is a bureau within the state government that is in charge of corporate charters and LLC registration, and they're generally the Secretary of State. In New York, we have the New York State Secretary of State. So in order to do this under the New York State statute, let's say, the articles of organization must actually be written by the founding members and must include at a minimum the name of the LLC, the address of the principal place of business or the registered office of the LLC, the name and street address of the initial agent for service of process, and whether the managers, who may not be members, will manage the LLC. So this will be important later on when we look at the differences between a member-managed LLC and a manager-managed LLC. So the member's contract or operating agreement ordinarily is not legally required. It could be oral as well. It does not have to be written. So unless the agreement states otherwise, it's assumed that amendment of the operating agreement requires unanimous resolution of its members. So the operating agreement, think of it as like a constitution or a contract in which the parties must operate. Much in the same way, the operating agreement addresses matters such as the sharing of profits or losses, voting rights of the various members, and what the circumstances are that may cause the LLC to be dissolved, which means terminated. Next, let's talk about the profits, losses, and distributions in an LLC. So, the funding of an LLC is generally from contributions from its members. So, the contributions may consist of tangible and or intangible property and services, and they may also include obligations to contribute cash or property or to perform services. So, a lot of times, the formation of an LLC will have in writing in its operating agreement the specific responsibilities of the members as it comes to funding, or what are the services in which the LLC members must contribute to the LLC. Perhaps you have two people come together to form an LLC. One has the money, the other one has the expertise. In this case, the contributions could be in the form of money from the person that has money, but could be in the form of services from the person who has the expertise. And these contributions don't actually need to be baked into the operating agreement. A lot of the times, an obligation to contribute at a future date is enough. So, without something in the agreement that speaks to the contrary, most of the state laws require that the profits, losses, and contributions are to be shared based on the value of the members' contributions. So in a lot of operating agreements, the services maybe, which is a contribution of one of the LLC members, those services may actually have attached to it a fair value associated with the value of a service. And therefore, when profits are supposed to be divvied up or losses supposed to be attributed to these members that are part of the business, they will look then at the value of the members' contributions. If you contribute more, you have more to gain, but more to lose. If you contribute less, you have less to gain, but less to lose. So a member who's part of an LLC may transfer, or in a legal term we call it assignment, his or her distributional interest without dissolving the LLC. This is because the interest is personal property, meaning that if I have an interest in an LLC that's operating, I can actually freely, without the consent of the other members, assign my interest, because the interest that I have in the LLC is a property interest. And that does not mean, though, that it's in much the same way as a partnership, that the person or entity that I assign my distributional interest to, that person or entity takes over as a member of the LLC. No, they simply get the right to the interest in that membership, not the membership itself. So another thing to note is that the members of an LLC may either choose to be taxed as a partnership, in which it would be a pass-through entity in which the partners are liable for the tax, or in this case the members, or they can be taxed as single member LLCs if there is one member in the LLC, and we call this a disregarded entity, and these are taxed as a sole proprietorship. So sometimes the members of the LLC will choose not to be taxed as a pass-through entity and be taxed more like a corporation, which is a taxable entity. And sometimes this might be advantageous, because if you have a lot of money and it's less tax for the to be taxed as a corporation in terms of corporate business income, then you might choose to do so. And you might actually choose to do so if you are going to reinvest a lot of that money back into the LLC, simply because you have more money going back in. If you choose to be taxed as a pass-through entity, you might pay, let's say, more taxes, but the advantage there is that you actually get money. So it's, do you want to put the money in, or do you want to keep the money for yourself? So how is it managed? So by default, the law deems LLCs to be member managed unless the articles provide otherwise. So in a member managed LLC, All members have the right to participate, and all business matters are decided by the majority. Contrast that with a manager-managed LLC, in which each manager, who may not be a member, has equal rights, and most business matters are decided by the manager or by a majority of the managers. So think of the difference here as the LLC is either controlled by the people who are the members, and business matters are decided through majority vote, or the members designate a group of people called managers, and those are the people that actually make the business decisions by majority vote. So most LLCs are member managed, especially if they're medium to small businesses. But as you get bigger, an LLC might shift to a manager managed model instead. So member managers have limited liability. So when does an LLC dissolve? Well, there's 4 instances in which it could dissolve, which means terminated, which means also not operable anymore. So the first is the expiration of a specified time period or occurrence of a specified event. You might actually write that an LLC is only in existence for a period of 2 years. Or you might write, by the time the LLC makes $500,000, that's when the LLC ceases to exist. The second scenario is consent of a number of percentage of members provided in the agreement. So the operating agreement might say that if 51% of the members consent to dissolving the LLC, then it shall be dissolved. So upon the occurrence of the consent of 51% of the members, provided you wrote it that way in the operating agreement, then the LLC will be dissolved. Next is the death of a member, if noted in the articles. So just remember, all of this needs to be written in the operating agreement. And then lastly, irrespective of whether it's in the articles or not, is a judicial determination of dissolution, which could happen in 4 scenarios. Frustration of purpose, in which the purpose of the LLC no longer exists. Impracticability of continuing, in which it's impractical to continue operation of the LLC. Inappropriate behavior, such as torts or embezzlement or fraud. And lastly, the equability of liquidation, which is maybe there's a lot of business obligations and debts that the LLC has incurred, and perhaps a court might want to dissolve the LLC in order to help people that are owed that money. So hopefully that's a good overview of a limited liability company. In part 2, we'll be looking at the corporation.